Welcome to the Pacific Research Institute's Next Round podcast. I'm Rowena Ichon, Senior Vice President, and with me, as always, is Tim Anaya, Senior Director of Communications. So the Republicans, Tim, eked out a majority in the House, and barring some unforeseen event, looks like Kevin McCarthy is set to be the new Speaker. So, Tim, you worked for him as Assemblyman McCarthy when he was in the legislature. So what's his governing style? Any insights you think you can give us? And how is he going to play this tight margin over Democrats?
Well, I think the first thing is that he's very, very political. He has like an encyclopedic knowledge of every one of these members and their districts and who's the up-and-coming Republican and what their opportunities are. So, I would expect that he will be very political as Speaker. And that's important because, believe it or not, the Republicans will basically have a mirror opposite small majority like the Democrats have today. So he's going to have to be, very political just to keep his own folks in line. Now, there is a chance, of course, unlikely, that, enough of the Freedom Caucus members will withhold their votes and, kind of force a second ballot. I don't believe that. I think that Kevin is very, very smart politically, and I think he'll, overcome whatever that opposition is in the end. Because all the kind of bluster you hear now, those are just people angling for a deal. And for Kevin knows what you have to hold the line on and what doesn't matter. And so I think he'll be fully prepared to deal on stuff that might be important for member X, but doesn't really matter in the grand scheme of things for his control of the House. So my prediction, he's going to win on the first ballot, and though it'll be close, I don't think we'll be going to ballot number 198. That being said, what impressed me was the last time I saw him, he gave a talk here at the PPIC luncheon in Sacramento. He has become very, very policy oriented. And that was always kind of the knock before, that he was very good politically, but kind of didn't really have a political or a policy agenda. I think he's much, much more focused on policy. And I think a Republican majority in the House will be more policy oriented than you might imagine, and especially given the small margins. The other thing that he's very smart about is he's very good about delegating across the conference. So yes, he's always going to kind of be there and be leading the show, but he's very good about delegating to member X who has a particular talent, or member Y who represents a particular interest, to kind of have that feeling of unity and to get everybody their moment in the sun. So I think you will definitely see that with him as Speaker as well.
So closer to home, this time last year, we were talking about a huge surplus in the California budget. And Newsom and the legislature went on a massive spending binge at the time. We've been warning all along of a coming shortfall, and it seems just overnight we're in the red. So you wrote a great blog about this.
Yeah, it's not surprising. California has a lot of boom-bust budget cycles. And with our economic uncertainty in America in recession, or, if you're very optimistic, on the brink of recession, as soon as we have the least bit of an economic downturn, that heavily affects our tax revenue, because California's state tax revenue, as for those listeners who may not know, that it's heavily dependent on capital gains taxes. And so those are hypersensitive to fluctuations in the market. And if you've checked your 401k lately, we have not had a great year in the market. So the issue now is, what does that mean for the budget that Governor Newsom will be proposing in January for the 2023-24 fiscal year? And what does that mean for our current year budget? And so right now, the nonpartisan legislative analysts just released their fiscal outlook. Every November they do that, and it really kind of kicks off our thinking about what the coming budget year is going to be. And they've estimated that They use a 3-year budget period. So you have the just completed 2021-22 budget year, because there's some extraneous spending and accounts being settled from that. And you have the current 2022-2023 budget, and then the forthcoming 2023-2024 budget. And they estimate over that 3-year period that we're going to have $41 billion in lower revenue than was projected in the state budget that was enacted in June. And for the upcoming 2023-24 fiscal year, they project a $25 billion budget shortfall. And they argue that if we indeed enter a recession, and they have not projected that we're in a recession, we could have revenues $30 to $50 billion below their current estimates. So what does that all mean for the budget? Well, what it means, and we're already seeing this in the actual tax receipts being taken in, have been significantly lower in the first few months of the year. So what it means is that come January, lawmakers are going to have to take some corrective action on the budget. They may have to suspend some new ongoing programs that were enacted. They may have to trim back things. They may, through fund shifts and accounting gimmicks, take some action. But the sooner you take action to address a budget shortfall, the better it is in the long run. So, that's why an easy place would be to delay or suspend new programs and spending that have been authorized in this budget or the prior budget to 2024, 2025, when we hope we'll have a better fiscal picture. Now, we do have a rainy day fund that is pretty stocked up. It's at about $23 billion, and we have some other reserves as well. So that's available. But the LAO cautions we shouldn't use that right now because we aren't, according to them, we aren't technically in a recession, that we should save those for, a real downturn. But you see, if we're going to have $30 to $50 billion in lower revenue than projected, that $23 billion isn't going to last very long. So it really shows you how, because of our volatile tax system, you can really go from a $96 billion surplus to a $25 billion deficit almost overnight. So the issues to watch coming forward: what will this new legislature do about it? Their initial kind of statements on this, they look like they're ready to fight to preserve some of their spending priorities and use some of the rainy day funds to do that. Historically, in the past decade and a half or so, governors have dominated the legislature in budget discussions and having their way at the end of the day. So will Newsom continue to have his way, or is he going to have to give on some of these things to get his budget plans through? Newsom rhetorically has been very cautious. He's adopted kind of the same language as Jerry Brown about not creating new ongoing programs with one-time money, about spending one-time money on one-time needs. He has been a little more liberal with spending compared with what Jerry Brown would have done. But I think there's a lot of unknowns. So we'll see in January, around January 10th, the governor will unveil his budget proposal for the year ahead. And that'll really kick off the budget debate. And so we'll see kind of what approach he takes. But I would expect that you're going to see a lot of whatever new spending was authorized in the current budget. I predict you're going to see a lot of that suspended, pushed off for a year, 2 years, 3 years. To get us through this deficit.
He might already be having the willies about the budget, just because the other day Newsom actually decided to suspend aid to municipalities and localities on the homeless. He felt that they weren't doing enough. So apparently there was a 2-hour powwow in Sacramento with the governor and the municipal representatives, and he subsequently lifted the suspension. But it remains to be seen. Something tells me that this time next year, we're not really going to make a dent on the whole homeless situation.
Yeah, I think that meeting was really all kind of a come to Jesus to let them all know, hey, we're serious about it as the state, and we expect results with the money that we're sending you from the state. But the issue is, as our Kerry Jackson and Wayne Weingarten have written many times before, and especially about Project Home Key, is that this approach, the approach that Newsom favors, hasn't delivered results, and it's very expensive. And if we're going to basically double down on this approach going forward, we're going to spend a lot of money and you're not going to get a lot of results. So really their kind of stare down should have been more about what are some new different ways that we can spend our limited state funds that'll make the most difference in turning people's lives around and getting people off the streets rather than just spending more money on the status quo.
Well, we have a special guest this week, Robert Baggott. He's a recently retired fixed income trader, was with a Capital Group for about 16 years. And prior to that, he was in institutional sales. So these days he does a lot of volunteer work, especially serving the sick and the poor. But now that he's retired, he's no longer a buttoned up Wall Street guy. So he came on our podcast and he let it loose. So we chatted with Bob about the Fed, interest rates, inflation, the economy, and he even gives investors a little advice on how to think of the current economic environment. And also Bob is quite a poet. So he reads one of his compositions at the end of the podcast.
Yeah, it's a really interesting listen. And if you're interested at all in kind of markets and trading and what we're doing today and inflation and the economy, you'll be very interested to hear what Bob has to say.
So thanks very much for listening. And here's Robert Baggott. Welcome to PRI's Next Round podcast, Bob.
Well, thank you for having me.
So the financial markets are still in a pretty fragile state. Inflation is the highest in more than 4 decades. And stocks as well as bonds suffered some major losses this year. President Biden, after the Democratic Party managed to thwart a Republican rout in Congress, says he's not going to change anything. So what's on your mind based on this environment?
There's a fair amount of uncertainty, tremendous amount of uncertainty. We've been through a 10-year run of declining rates and rates suppressed. Now they've spiked because of inflation. Most of people's investment outlook involve seeking return on your capital you invest somewhere. And I think we're in an environment right now where what's going forward is very hard to determine it. And I'm very focused on return of capital rather than on capital and risk averse. We are mice at the elephant's feet right now relative to macroeconomic policy, monetary policy, the Fed, et cetera. And the possibility for being wrong in any direction is greater than it seems at any time, and frankly, in my career. And I'm focused on not losing everything that I've had. And I would give that advice to anybody else. Tread carefully and focus on return of capital rather than on capital, because the asymmetries around risk right now are great.
So the Fed's goal obviously is to try to take inflation down to about 2%, but there's a lot of voices coming from politicians and of course from some economists who say that the economy has had enough of interest rate hikes and that the Fed should really slow down or take a pause. What's your view?
Well, when you say there's a lot of voices, there's always a lot of voices. And it's politicians, economists, touts at Wall Street firms. Everybody's got an opinion. The entire system does not work very well if rising interest rates. So there's going to be a lot of people talking what Fed policy should be based upon their own book. There's a concept in talking about markets where you have to assume that whatever voice is out there has got an axe to grind, and they are going to talk their book. In other words, their position, the investments, their position in the marketplace, where they stand, their ability to make money, talking you into something. All of it is, there's no neutral opinions when you talk about voices. What do I think? I think that we've had manipulated rates for, my working career and central planning around where interest rates should be. And I don't know that we have a real concept of what the clearing rate for what's the U.S. 10-year, if it was without intervention, where would it clear? What would be the rate that the U.S. 10-year would be? And we have no clue. There's been thumbs on the scale for a very long time.
So, leading to what you think about the Fed. So how do you think they've conducted themselves over the last 7 months? And as you alluded to, in the last 7 years. So how would you advise monetary policymakers right now?
Well, that's presumptuous. Yeah, you have to understand. I was a line guy. I was a trader in the front end, finding execution, finding the best price one way or the other. And while I had strong opinions about what you should do or what strategies should be, I never was a person involved in macro policy or view of what overall monetary policy should be. But I do have strong opinions because I'm a trader, and traders can't lie to themselves because the price is the price, and you wear your own errors. And if you put your trade ticket in the drawer because it was wrong, bad things happen. So you have to own up to everything. So traders as a crew tend to be a less dreamy, less, how would you put it, optimistic. The basic rule is everybody is out to get you, and you live that way. So when you look at Fed's monetary policy, I'm pretty cynical about it. Over the last 10 years, we've seen the greatest wealth transfer in history. The borrowing class, and by that I mean people who have assets that are qualified for some kind of borrowing collateral, have been tremendously rewarded by suppressed interest rates for a very long time. And the greater the asset base that you control, the greater borrowing that you could do at suppressed rates. And that's all resulted in a massive asset inflation that has rewarded the wealthy. And if you don't own assets, all it did was make you further behind relative to those that had pledgeable assets. And it's just astonishing that it's gone on so long. We're seeing the reality of you can't do this forever, and nothing that doesn't make sense can go on forever. And how it's going to break out, I don't know. So how would I advise monetary policy makers right now? Like, have some humility. It's just look at what you've done. But that advice is, how can I say it? It's a noise in the wind. It will not. Some guy who is a retired trader is not going to affect Fed policy.
So many of the major investment houses and companies are forecasting a pretty severe recession for 2023. What are your thoughts? And do you think our Fed Chairman Powell has the stamina to resolutely continue his fight against inflation if the signs of a big economic slowdown continue to pile up?
That's quite a question. An economic slowdown on the back of 10 years of zero interest rate policy is inevitable when you face the inflation that we're facing. Do we have the stamina? I'm not sure that's the right word. Does Chairman Powell have the standing and the ability to put up with the political pressure that will come upon him from all directions relative to their tightening or easing policies? I will say this, when you talk about major investment houses and companies, their forecasting is, again, like I had said before, is talking their book. The entire financial engineering industry does not do well in these environments. And so easy money is it's the history of the United States. Financial interests push very hard for easy money. The Fed actually is a creature of the financial system. It serves it. It has a dual mission, theoretically, around full employment and stable prices, but effectively it is part of the vast financial system, and it will no doubt in the end do what it is bid. I do have. Forgive me on this. I'll read you my short poem. I write poems about business, and the FOMC, which is the Federal Open Markets Committee, which basically sets short-term rates, is a committee within the Fed, and they have this communication method in which they project future rates by putting dots on a chart about where they think rates are going to be out in the future. So this is the short version of the poem that I wrote about the Fed. The FOMC, or my teenagers when they tell me they are going to take out the trash. Don't ask me my thoughts about the dots. Powell's opining has me declining to trust what the Fed says they'll do. It'll be mooted by something that's new. So they are a creature of the system, and in the end, they'll do what the system demands.
Yes, but Bob, what's good for the American people? What's good for the working and the middle class who are trying to work through this inflation? They see their gas prices going up. They see food prices going up. What should the Fed do to help ease the burden for working and middle class people? You can take your Wall Street hat off now.
Well, markets matter, and I think that the allocation of capital that would be significantly to the benefit of this average citizen of America, were it not directed to private equity borrowers who can take cash flows of businesses and accelerate future investment into the now so that it can be capitalized at below market, below the clearing levels to generate wealth. We've seen that over and over and over again. The venture capitalists that find a way to convert income streams at cap rates that justify fantastic valuations and justify borrowing in significant amounts that would not normally be available in the marketplace had the Fed not created this interest rate environment. I think if were they to allow clearing rates for risk capital to be what they are, rather than manipulated by intervention, I think we would see a much more rational allocation of capital throughout the economy and less of a favoring to the borrowing class.
Polls show, obviously, that inflation is at the top of Americans' minds. And President Biden, though, if he doubles down on his current policies, is likely going to make it worse. And as we saw last week in his post-election press conference, that appears to be the direction he's going. So what do you think the new Congress in a very divided Washington can do, if anything, to help mitigate this?
Well, I think to the extent that the Republican slim majority in the House has a solidarity, and that's an assumption, say no. I think there are extra constitutional and executive efforts that might be made out of the presidential office to the extent that there's no pushback and there's no, in other words, the forgiveness of student debt or whatever it is that looks like that down the road. To the extent that there's no break on that through the judicial system or I don't know, Congress finding a way to stop it. Their only solution here, given that we have a divided government, is to stand at the wall and say, no, we're not going to blow money on this, or no, we'll take the political heat for not a wealth transfer to whoever's clamoring the loudest and say no. Now, whether they can do that, historically, you can say Republican or Democrat have a difference in how they're looking at it, but there has not been a lot of interest in Congress in saying no to anything. We've seen the triumph of universal suffrage welfare state model post-World War II. And that structure has to provide the stipends and services necessary for politicians to get elected and reelected. At the same time, there's influential and powerful interests that demand a place in the distribution of economic benefits. So we've got effectively a philosophy of economics, Keynesianism, that now reigns supreme because it serves those needs. I don't think a Republican Congress with a narrow majority is actually going to put on any brakes. And I don't think that this concept of modern monetary theory that borrowing does not have a deleterious effect, and that we accelerate the future into the now, it's just going to continue. I'd like to say that Congress would stop it, but I doubt they will. Just get ready. And I would say that's why I started in the beginning of saying focus on your risk profile and return of principal rather than return on it. And I would say people who participate in the financial markets usually are taking on more risk than they know.
So let's be a little more academic now. I know you're a fan of Frederick Hayek, a great economist and a good friend of our founder, Sir Anthony Fisher. In fact, it was Hayek who advised Sir Anthony to take his fortune and seed think tanks around the world. And that advice was a genesis of the Pacific Research Institute. So what do you think Hayek would make of our current economy? And what do you think he would advise President Biden?
That's two questions. The first one, I don't think of Hayek particularly as an economist. He's more a philosopher. He certainly was an economist, but he had to say was at a level above just thinking about the economy or numbers in terms of how to organize financial system. His collection of essays, The Constitution of Liberty, was focused on political systems that value the concept of liberty. One of the things I'm frightened about it seems a tremendous amount of this nation and most of the developed world no longer thinks liberty is on a level of ease or comfort. But he certainly felt that way. His seminal piece in the public mind was The Road to Serfdom, and it's astounding to realize that there was a Reader's Digest that was such a national footprint in the United States, where an essay shaped for the average reader had such a political effect in the backside of World War II, where central planning, he pointed out, was the road to serfdom, that we would eventually have masters who would tell us what we had to do. And that is the fatal conceit, which was a summary of his discussion of the hubris of central planning. So I don't think of him necessarily as an economist. I think he would look at the central banking systems across the developed world and be aghast that we've turned our economies and our policy-making decisions over to an extremely small number of policymakers who wear a badge of advanced degrees and the ability to do Greek math into basically control of the economic levers of world economy. That would be anathema to Mr. Hayek. And now, what would he advise President Biden? Well, I would more say, what would he advise the office of the president? The cow's way out of the barn, and the dam's busted. So I don't know specifically. I can't imagine what he would advise the current office of the presidency, other than look inward and recognize the limits of your power and recognize the impact of these decisions that affect millions upon millions that are basically based upon policies that are dreamed up in think tanks.
That's funny, Bob.
Sorry.
That's okay. We love it.
In other words, markets matter. And there is nothing that is fairer than allowing individuals make their own decisions about where to invest their capital, at what rate, with whom. And we haven't seen a real free market in decades. And when this all crumbles, and it may, who knows, maybe we'll get through it, but when this all crumbles, I'm afraid that they're going to end up blaming markets for this, that somehow, quote, capitalism, unquote, is at fault, when we haven't seen anything resembling a market-based policy in my working life, and I'm 66.
So I'm going to ask you what I think is the ultimate open-ended question. So when we're thinking about all of these issues related to the economy and markets and government spending, what is keeping you up at night?
Deep breath. I studied history in college. I was not a quant. I didn't study math. I did Russian studies, East Asian history. This one is not particularly in that universe, but what keeps me up at night is the Spanish election of 1936. So you had basically a division between liberal forces, a popular front of socialist organizations that ran against monarchist parties, and the outcome of the election was very narrow. The population of Spain was equally divided from, you could say, conservative and socialist camps. And in the end, the Spanish election of 1936 was decided narrowly in the favor of the socialist groups. Okay, fine. But they took that mandate, which was a narrow, just tiny majority. And they took that as the opportunity to remake and reshape everything about Spain. And that is the ultimate hubris, in that if you seek with a thin majority like that to alter millennial old customs and ways of doing things, you will get resistance. And human beings are nativistic, tribal at heart, and any pretense that we are above the chaos of what ensued from the election in 1936 with a civil war that was devastating, shattered that nation. If you think that we're above that now, that it could not happen here, I just don't know. They're playing with fire to the extent that that we're seeking to remake everything about our culture and how we organize things over these very thin majority. And I worry, because I know, we all know people who are angry, upset, and refuse to participate in the pathways that are being pushed. And where that goes, again, when I would sit in a meeting and somebody would give their case for an investment and say, well, my worst case scenario is we're down 20% or whatever their calculations were about if it all goes wrong. And I always used to think, and often would quip until it got too old for me to quip it, which is if your worst case scenario does not include artillery shells falling on Wilshire Boulevard, you don't have an imagination. And human nature is, we periodically get together and all decide we're going to just blow everything up and burn everything down. And 1914 is a good example of that, and we're not beyond that. So that's what keeps me up at night. Sorry.
Let's turn to your expertise as a bond market fella. Could you advise our listeners, where is the value in the market now? Or should we go with treasuries all the way?
So the first thing to say, and I've already prefaced it, that everybody's got an opinion. And everybody talks their book. And my opinion is driven by an asymmetry of what I can achieve at the age of 66 in terms of taking risk, and versus what I could lose after accumulating some assets over a very long career. So definitionally, I'm going to be risk averse from my point of view, because again, asymmetries are something that as a trader you look for. And so to the extent that there's things out there that you can take risk on for significant reward, there's a time frame. It all depends. And also, what's your capacity for being wrong? In other words, if I'm wrong now and I lose too much money, I can't make it back. If I'm 32 years old and I accumulate a bunch of interesting bonds, I'm wrong. I've got a lot of time to fix what I've done. So not everybody has the same outlook. And that's one of the reasons I say most people have more risk than they can take. We've had the masters of the universe tell us that you don't sell into a downturn. You hold the course, because over time you're going to be right. But that assumes that you have an entity, or you're wealthy enough that you can survive dying financially. And most people can't. And so when they get stuck in a market that's plummeting, they sell. And everybody says, oh, how dumb that was. If it turns out after the fact that the market recovers, why did you sell? Well, the reality is most people do not have the staying power to survive what they don't know. And because they ended up not realizing how much risk they had, they take their chips off the table. And at the time they do it, it's an extremely rational thing to do, because we don't know where we're going from that point. So that's a preface. I'm moving on from there to say, if you have a risk appetite, right now, out in the marketplace, there's a tremendous amount of bonds, and that's what I know, that are based off of securitizing structured real assets, real estate, commercial real estate, all kinds of different things, automobiles. There's an infinite number of bonds that are backed by something that's real in the economy, which have structures that are different. And when I say different, I mean there's all kinds of call options, and the collateral is worth something or not worth something. And there's a tremendous amount of mispricing of structured assets. To the extent that you have access to someone who is investing in structured products or taking credit risk around real estate in the bond market or whatever asset class you're talking about, picking an advisor, a manager, someone who's really good at that, if you're an investor, can provide significant returns, because this is a perfect and great opportunity for bond selection beating indexes. And smart people pick the right bond. And that's a real talent. It's a real asset. But you have to be careful, because there's people out there that claim to know what they're doing, and they don't. And who knows? And it looks cheap at 85 cents because but it's not, because it's probably worth 50 cents. So you have to be really careful about that. But to the extent that you have a risk capacity for structured products, for things that where you're going to be right versus everybody else's opinion in the marketplace, that's a good place to invest, but it's hard to do. If I was giving advice to a general population, I would just look at the yield. And I would say right now the market is telling us we're going to have a recession. So we have an inverted yield curve, which means the bonds at the longer end have a lower, when I say longer, I mean longer in duration, 10-year, 20-year, 30-year, have a lower yield than bonds in the front end of the curve, 6-month, 1-year, 2-year bonds. And I would suggest, if you're in the bond market and if you are afraid or cautious about equity markets and where we're going here, that something in the portfolio of 1 to 2 year yielding assets, frankly 6 months to 2 year assets in fixed income, is going to offer the best yield and preserve your capital in the best way. And so I would advise people to, unless they have an access to smart people who can take risk in the bond market, to have a portfolio of 6 month to 2 year duration. And it's well north of 4% yield right now. We were at 0 for a long time. So the symmetry of what loss possible versus gain possible it seems neutral there. And it's I don't like taking long duration right now. There's just too much chaos. The bond market has actually rallied in the long end in the face of a possible recession, but I don't think inflation's under control. And I think it's a wrong move to have long duration.
Well, after all this depressing talk, I think we need a drink. So, we call our podcast Next Round because of all the great wineries in California, and we love nothing more than talking about public policy over a glass of wine or a cocktail or one of the great beers brewed in California and elsewhere. So now we're coming into Christmas and the holiday season. What wine, beer, or cocktail would you recommend to our listeners to try to take their mind off of some of these depressing topics?
Well, first of all, I'm not depressed. I think that these are all issues, all difficult things. But if you look out the window like I am, the houses are going to remain standing. I don't think artillery shells are going to fall on Wilshire Boulevard. People go about their daily business. And the people that make noise, who want to cause us trouble, are a minority. And the people who have an open heart for everyone around them are all around us. But we're trained to not hear them. We're incessantly beaten by the people that want to make us fearful. The media has monetized fear, and so I'm not depressed. But that being said, I like a cocktail. So we're going to answer the question. I'm afraid I'm absolutely and totally monomaniacal about my drink. You could offer me a tremendous California red that was worth hundreds upon hundreds of dollars, and I would go, yeah, that's okay. And white wine seems insipid to me, and it's like not worth the trouble. I do like beers of all sorts, but I have one drink, and it's a sailor's drink. I spent an awful lot of time in the water. I'm over here in Catalina looking at the water, and I love the water. And there's a sailor's drink. It's rum and tonic. And I will drink rum and tonic in the dead of winter, in the height of summer, whether I'm on a boat, in a yacht club, or in a dive bar. It's rum and tonic. And I do like Mount Gay and tonic. I do like Myers and tonic. You've got probably a handful of really good rums that'll mix well with tonic. You got to stay away from the fancy, super expensive Central American rums that have really kind of interesting bite. You more drink those neat, but for your basic cocktail that you're having because you want a cocktail, Mount Gay rum, and get the red hat, because then everybody will know you're a cool guy. There's a red hat with the Barbados on it where they make it. And I think it's Barbados anyway. And you got to wear the hat. It means you're a sailor. And tonic with lime. And so I need 2 lime wedges. And I always specify that. So if they don't have Mount Gay, it's Myers, little darker, not as good. But that's my drink. And there was a time I could have 10 of them. If I have about 2, I'm good for the night, and probably no good for 2 more days after.
We'll have to have you back. Thank you so very much.
Here's a poem about the Fed that I wrote in the Bernanke, and it's entitled "The Fed Through the Looking." I used to laugh and sneer at crazy Uncle Pete, living in his cabin and ranting about the street. All you money guys are just a bunch of whores who sell us down the river while financing our wars. I thought I knew how the world worked, not a fool was I. Savvy and professional, I'd never be that guy. Well, Pete's still crazy as a swarm of bugs in bed. Crazy is as crazy does. Just think about the Fed. Just like Humpty Dumpty, the world's had its fall. Like Alice through the looking glass, I'm addled by it all. Prudence is no virtue, and saving is a sin. Profligacy is called stimulus, and limits are just spin. Creditors are scoundrels, and debtors called a tune. The people serve the government, the dollar's in its swoon. What's a dollar even worth? I find it my dismay. The Fed's like our friend Humpty. It's worth just what I say. The Fed reveres its patron saint, inestimable Lord Keynes, who gave eternal license to spend beyond our means. If aggregate demand should ever fall, blame not a busted bubble. It's not the time to quit the game. It's time to wager double. They've marked the cards and dimmed the scale to force the world's hand into taking risk with shrinking spreads, which is our command. If crazy is as crazy does, then what makes the maddest hatter writing all these March hare rules or thinking it doesn't matter? Well, I'm glad you had me. I pontificated, and you're very brave to ask me to come on, because it's not everybody who wants to hear me drone, and I'm kind of reduced to talking to my dog because my wife can't take it anymore. And ever since I retired, I have all this bottled up, and you've uncorked it, and I really appreciate it. Thank you.
Thanks, Bob.
All right. Bye-bye.
If you like this episode, please tell your friends and subscribe to PRI's podcast at iTunes, Google Play, Stitcher, TuneIn, iHeartRadio, and Spotify. And when you're on these platforms, don't forget to give us a big 5 stars. If you don't subscribe to any of these, you can still listen on PRI's YouTube page, youtube.com/Pacific Research 1. That's the number 1. Thanks for listening. I'm Rowena Ichon. Hope you'll come back again for next round with PRI.